Today, I want to talk about something that might challenge the way you've been thinking about XRP, because most people who own it don't actually understand what they're holding. And I'm not saying that to criticize anyone. I'm saying it because there's a real gap between knowing the headlines and understanding the purpose. A lot of holders know the surface details. They know it's fast, they know it's cheap to send, they know it's connected to banks, they've heard all the narratives. But when you ask a simple question like what problem was XRP specifically created to solve, the answers start to scatter. You'll get 10 different explanations, and most of them only touch part of the truth. And that matters more than people realize, because when you misunderstand the purpose of something, you automatically evaluate it using standards it was never built to meet. That's exactly why frustration shows up around price. That's why debates repeat themselves over and over again without ever really landing anywhere. One person sounds confident, another person sounds equally confident, yet they completely disagree. The reason is simple. They're not arguing about the same premise. They're operating from different assumptions about what XRP is supposed to be. Some people treat it like a speculative investment that should explode based on hype cycles. Some treat it like a payment token that should rise with transaction volume. Others describe it as infrastructure that quietly supports financial systems behind the scenes. Each of those perspectives leads to a different expectation, even if everyone is staring at the exact same chart. So when the price doesn't move the way someone expects, they assume something is broken, they assume manipulation, they assume failure. But often what's really happening is a mismatch between expectation and design. XRP doesn't fit neatly into categories people are already comfortable with. It's not a stock, it's not trying to function like a traditional growth company. It's not positioned to replace banks entirely, and it's not engineered to behave like highly speculative meme assets that spike on emotion. When someone says XRP should already be at a certain number, what they're really saying is they're applying a framework they already understand to something that doesn't operate inside that framework. And that's where the disconnect begins. Because understanding XRP requires zooming out and thinking about moments most people don't like to think about. It requires considering cross-border liquidity, settlement friction, and what happens when financial institutions need to move value instantly without pre-funding accounts across the world. That's not a glamorous conversation. It's not built around excitement. It's built around efficiency. So if you're holding XRP, this is one of those discussions you actually want to sit with until the end. This is not financial advice. It's for education and perspective only. But if you've never paused to question the assumptions you're using to judge this asset, that pause might change how you see everything. If you don't step back and ask what problem this was actually designed to solve, everything about it is going to feel off. The price will feel disconnected. The explanations will feel incomplete. You'll start wondering whether you missed some secret piece of information that everyone else has figured out. And what I want to tell you is that you are missing something, but it isn't hidden data or insider knowledge. It's context. Context changes everything. Once you understand the environment XRP was built for, the frustration starts to soften because you're no longer judging it by the wrong standards. So before we go any further, we have to go back to the foundation. Not what people hope XRP becomes, not the projections, not the speculation, not the narratives. Why does it exist at all? Because XRP wasn't created to look impressive on a chart. It wasn't engineered to excite retail investors or dominate headlines. It wasn't designed to fit neatly into conversations about market caps or price targets. At its core, XRP was built as a neutral settlement asset, and neutral is not just a descriptive word. Neutral means it doesn't belong to a single country. It doesn't depend on one banking system. It doesn't require two parties to trust each other personally in order to complete a transaction. At institutional scale, that matters in a very real way. Banks and clearing entities don't settle obligations because they feel optimistic. They settle because they must. Those obligations don't pause when markets are volatile. They don't wait for better sentiment. They don't care about social media narratives. Settlement has to happen cleanly, finally, and without adding more risk. And that is the layer XRP was designed to operate on. It isn't trying to replace banks or compete with stocks. It sits underneath as infrastructure, and infrastructure is invisible when it works. Nobody talks about plumbing until it fails, but when it fails, everything stops. Once you see XRP at that level, you start to understand why it doesn't behave the way speculative assets behave, and why surface explanations about speed and low fees never quite feel complete. Because speed and cost are features, not the mission. They are tools that support the real objective, which is reducing friction and value transfer when multiple systems that do not naturally trust each other still need to interact. That is a very different design philosophy from something built purely for appreciation or retail excitement. It also explains why timelines feel slower than people expect. Infrastructure integrates gradually, it gets tested quietly, it connects behind the scenes before it ever becomes obvious on the surface, and during that process, it can look stagnant from the outside. But stagnation and preparation are not the same thing. When you start looking at XRP through the lens of systemic function instead of daily speculation, the emotional charge around short term movement begins to fade. You stop asking why it isn't acting like everything else and start asking whether it is positioned where it was always meant to operate. And that shift in perspective is where clarity really begins. Now, one of the most common explanations you'll hear is that XRP doesn't need a high price because it can simply be reused. Institutions can access it on demand, use it briefly to settle transactions, and release it back into circulation. In calm conditions, that logic sounds efficient. If liquidity is always available and exchanges are functioning normally, then holding large reserves doesn't seem necessary. It feels like renting equipment for a short job instead of buying it outright. That idea resonates because it matches how modern systems are built: on demand access, minimal inventory, maximum efficiency. And to be fair, that framework works in stable environments, but it rests on a powerful assumption. It assumes liquidity is always there when needed. It assumes access never freezes. It assumes stress doesn't change behavior. And that assumption is where the weakness lives. Because XRP wasn't designed only for calm conditions, it was designed with stress in mind. When access tightens, when trust breaks, when borrowing liquidity becomes uncertain instead of convenient, the entire equation shifts. You don't need complex terminology to see this. Just imagine owning something valuable on paper but not being able to access it quickly enough when timing matters. The problem isn't value, it's access. Scale that up to banks and countries. They can't simply wait. Obligations still need to clear. And in stressful environments, liquidity isn't shared freely, it's protected, it's hoarded. Systems don't automatically self correct. History shows they stabilize by pushing pressure forward until stress forces a structural adjustment. XRP was built with that kind of reality in mind, not as a comfort tool, but as something already neutral and already positioned to function when access itself becomes the issue. And this is where the conversation starts to deepen because most people are evaluating XRP through the lens of convenience rather than necessity. Convenience assumes choice, necessity removes it. In comfortable markets, participants behave cooperatively because they can afford to. Credit flows easily, counterparties extend trust, lines of liquidity remain open. But when uncertainty rises, behavior changes instantly. Institutions prioritize self-preservation. They reduce exposure, they pull back from lending, they hold on to what they control. That is not a flaw in the system. It is a human response to risk. And any asset that relies entirely on borrowed liquidity during those moments inherits that risk. The idea that XRP can always be sourced exactly when needed assumes that markets will continue operating smoothly under pressure. But history does not support that assumption. Markets seize, transfers slow, counterparty confidence weakens. In those environments, having direct access to a neutral bridge asset is fundamentally different from hoping it will be available. This is why the reuse argument, while logical in theory, becomes fragile under real stress. Because reuse depends on circulation, and circulation depends on confidence. If confidence drops, velocity drops with it. And when velocity drops, the system demands certainty instead of efficiency. XRP's design anticipates that shift. It assumes there will be moments when access is the real bottleneck, not theoretical value. It assumes there will be times when neutrality matters more than familiarity. And when you begin to factor in that possibility, the entire pricing and liquidity conversation stops being about convenience and starts being about resilience. This is where conversations about market cap and low price assumptions start to unravel. Traditional market cap logic assumes orderly trading conditions. It assumes smooth liquidity and rational behavior. It assumes buyers and sellers are always present, spreads remain tight, and the mechanics of exchange operate without interruption. But crisis environments don't operate that way. When systems are under pressure, price doesn't move according to retail expectations or neat valuation formulas. It reprices according to function. It reprices according to urgency. If an asset becomes necessary for settlement at scale, its valuation reflects the need to move large amounts of value efficiently and reliably. A very low price at institutional scale creates friction because more units are required to settle the same obligation. More units mean more transfers, more balance sheet movement, more operational strain, and more exposure to slippage in stressed markets. Higher price isn't about hype or ego, it's about compression. It's about being able to move significant value with fewer units more cleanly, with less mechanical stress when timing matters most. If XRP is never required at that scale, then yes, it can remain quiet, it can trade sideways, it can look underwhelming compared to assets that thrive purely on narrative cycles. But if and when it becomes essential infrastructure, it won't behave like assets people measure with familiar retail frameworks. It won't respond to excitement the way meme-driven markets do. It will respond to necessity. It will move because the system demands it, not because sentiment flipped overnight, and that distinction changes how you approach it entirely. Instead of obsessing over daily candles and short-term volatility, you start thinking in terms of structure. You start asking where you're holding it, how it's secured, what your tax exposure looks like, and how it fits into a broader long-term plan rather than a short-term trade. For me, that shift is practical. It means using platforms like I Trust Capital to hold assets inside a Roth IRA so that if long-term growth materializes over several years, it compounds without being eroded by taxes. Being able to trade within that structure while keeping potential gains sheltered creates a layer of strategic flexibility that most retail investors overlook. It also means considering premium custody solutions for assets held outside retirement accounts, particularly for those who want exposure without leaving funds sitting on exchanges. Closed loop custody environments reduce exposure to common risks like hacks, phishing attempts, and compromised credentials, while still allowing 24-hour trading access and diversification into assets such as USDC, Ethereum, Solana, gold, and silver. Having multiple asset classes within one structured environment allows you to think in terms of allocation rather than reaction. There are no monthly account fees in those setups, pricing is transparent, and even funding bonuses can make initial positioning more efficient. But beyond tools and platforms, the deeper shift is mental. That's why I built my coaching community around structure instead of hype. We focus on portfolio construction, risk management, tax awareness, and decision making under uncertainty. We talk about what to do when markets feel euphoric and what to do when they feel uncertain, so decisions are made intentionally rather than emotionally. Accountability matters because information alone doesn't change outcomes. Implementation does. And I'll say something that often gets overlooked in these conversations. Your health is part of your wealth. If you're exhausted, anxious, and constantly reacting to every price movement, you're going to make poorer decisions. Clarity, discipline, and long-term positioning require stability, not adrenaline. Wealth is built through structure and patience, not noise. If this perspective added context instead of confusion, share it with someone who needs a calmer lens. Stay wise, stay disciplined, and I'll see you in the next one.